Yeah, hi everybody, and welcome back to our live session today. This is me, Abhishek Banerjee, founder at Lotus 2, along with my co-founder, Dr. Prachi Devskar. Glad to be with you again this week. We will first take up some of the questions that were raised last week when we did the live. So we, of course, take questions from our viewers and we try to work on those questions over a week and come up with a good answer, not a off-the-cuff answer. So that if you have any questions, please put those questions in our comments so that we get a chance to work on your questions in a more serious way and come back to you with a proper answer. But that's it, Prachi. Where should we start from?
I think let's start with an overview and then we'll go to last week's questions
Sure.
and then take some questions from
Cool.
this week
Okay.
as well.
Okay.
Yeah.
Yeah, so I think, overview wise, Prachi and I we were just discussing, I think a couple of things just to put some headlines in context, right? We know that, Ukraine has backed down from its position and has given some indications that they might be willing to work on a deal to end the war. We know that tariffs are inflationary in nature and tariffs are not abating. I think people are working out how to control tariffs. So that means inflationary pressures continue to remain in the economy because of tariff. And tariffs essentially are tax on consumers. It's another way to tax. Tariffs are income for governments on both sides, right? Then, of course, we have seen the markets kind of stabilized at around 23,000. And then from that point, markets have, given way a little bit more. People who follow technical analysis, they are calling the next bottom at around 22,000. We don't know. I mean, these are supply demand equations. We, of course, also know that, Indian currency has depreciated quite a lot. We know that RBI has opened up a 40,000 crore liquidity window, $10 billion dollars actually, and 40,000 of that is deployed, I think, as we speak. And we, of course, know the forward premium on the bond yields are getting pushed because of this. But anything else that you can think of?
No, yeah, it's in general it is highly uncertain environment, particularly on the global space, and India is kind of reacting to that in different ways. And so the key question here really is, what is the prospect for long term investors?
Yeah. So I think, first of all, what is long term, right? Let's kind of define that once more. Long term is anything above 5 years, right? Anything below 5 years when you're an equity investor, you are kind of depending more and more on the luck. So, more less time you have, more lucky you need to be, right? And that's as simple as that. That doesn't mean that short term equity gains cannot be made. It's, again, as I said, even there is a quote by a Nobel laureate who says that markets over a long term are predictable, but over a short term, in the 1 week to 6 month time frame, they're pretty unpredictable, right? So but different people have different approaches of getting some sort of direction out of this.
I think many even long term investors are having this question that yes, I am a long term investor. I want to invest for 10 years. I want to invest towards retirement, towards a particular goal. But even they are having second thoughts right now about in the falling markets, and whether even for long term investors, whether this is the time to invest, right? And the for long term investors, the problem with kind of trying to time the market, which is very difficult, is that with the fear of markets going down, or in an effort to avoid market downturns, many often miss the opportunities that come along the way. And so for long term investors, it is always time to buy, because we don't know in the short term what will happen, but we know in the long term that is the way, disciplined way to create wealth and
Yeah.
accumulate
And
wealth.
on that point, I just want to bring up a data point that if you miss the top 5 days of return in a given 5 year period, right? So let's say we don't know which those 5 days are, but if you just were not invested in the best 5 days in a 5 year period, your return will be substantially different than somebody who just was a systematic investor. So just to prove a point that just missing out on the best days has far more bearing than trying to time it, and it's very difficult to do that. Let's talk about a few important points, like maybe first start with the questions.
Yes.
I think question from I Parry Everything, who made a comment that what is your view on precious metals, gold, silver, and do you think this rally in precious metals will continue? And ideally, how much of my portfolio should I allocate towards precious metals? The colloquial answer or the empirical answer is 5%, right, in gold. But you can use it as a strategic. So there are two kinds of asset allocation: strategic asset allocation and tactical asset allocation. Strategic asset allocation means that it's a asset allocation that you keep constant and you review and rebalance maybe every 3 years. Tactical allocation is something which is tactical is another word of timing. So where you have very high conviction around a particular asset class, you can increase your weight on that asset class compared to what you would normally do. We had been telling our customers, who were our customers back in August 22, please increase your gold allocation. Gold has rallied a lot since then, but the gold is kind of one asset class where there is a natural demand from central banks now. Currencies are under pressure because of tariffs and inflationary pressures. Typically inflation causes currency devaluation, right? So their precious metal continues to shine. The general per capita income increase. India, China are natural gold buyers, so there is a natural demand coming in for gold. And apart from that, we are seeing that people are even questioning the way these fiat currencies, fiat in Latin means in faith, which means that all the hard currencies, as we call them, or the foreign currencies like dollar and euro, they are backed by nothing but faith. So at a certain point, if their debt becomes unsustainable, then maybe there is going to be a large currency revaluation. So based on all these concerns and the fact that gold investors over a long term, they have never lost money. People are just buying gold, and which is pushing up the prices. I think for from what we can see, I think for the short term, I think gold has kind of peaked out, in our opinion, and to that extent, I think therefore it also means the risk of is kind of completed.
So in general, right, when investors panic or have limited risk appetite, gold increases in value because people feel it is safe to put money in gold. And exactly for all the things reasons that Abhishek talked about, there is a place for gold in your portfolio. But on the basis of gold alone, you cannot uh, accelerate wealth accumulation in the long term. And so that is the key thing to remember. And one can sort of think about um, small cap stocks in sort of an opposite side of the spectrum of gold, right? And they generally get battered a lot during market turmoil, but they are also the ones who tend to recover faster and more when the recovery starts happening, right? And so having some allocation to small and mid cap, without waiting for the recovery to start happening, is might be a way to give boost to your long term wealth
Right.
creation.
Right. And so that brings back, just to answer the question, I think 5% allocation seems fine, no? The next question is from Aditya Chahan. He's like asking, when is the market expected to get paced up or maybe get a little better? A little better, I think, anytime, right? So I would say uh, our feeling is that it's about the bottom, where we don't see any further bad news, right? And we are only seeing good news not getting priced in. For example, possibility of a 3 year long war ending, possibility of trade deals getting happened between multiple countries on the back of the threat of tariffs, possibility of kind of labor getting tighter because of immigration is tighter, so undocumented labor cannot be used to increase productivity of economies, which means that there'll be general wage pressure, which means essentially there'll be more money in the hands of people, and so on. So some of these factors, and apart from our Indian global macro factors, like the balance sheets have never been healthier of banks, the fact that capacity utilization is at near all time peak, which means new capex has to be added to meet increasing demand. Also, capital is more efficient because there's less friction from undocumented sources and so on. So overall, there is the directionally we are at the right path. I think timing wise, you can be off couple of months, and that's why it's important to average it out with an SIP. But we don't see a lot of rationality as to why markets should fall further from where we are.
Um, one related point here, right? It is we've talked about long term investors and possibility of wealth accumulation, right? But it's always very important to keep the risk side in perspective and have the allocation in line with your risk appetite. So even when we are saying that, okay, um, this is time to invest, this is time for long term wealth creation, buying opportunities, right? It is important to kind of keep the allocation in line with your own risk
Yes.
appetite. So just because this is buying opportunity does not mean that you should take excessive risk and create portfolios that are out of line with your own risk appetite.
It's a prescription, right? So just because, like, the let's say you get a prescription of to buy take two tablets over 10 years, 10 days, your pharmacy sells you the whole leaf of tablets. Doesn't mean that you can take all of them. So depending on what your appetite is or what the right dosage is, you have to ensure that you're consuming risk appropriately so that you are comfortable, right? It's really like the market doesn't care. It's really your comfort and your money, and you're the best keeper of your money, so you have to be comfortable with whatever risk you take, and that is the whole purpose of this risk profiling. The next question is from Simran Nangia, who is basically saying that she got recently employed. I recently got employed. I'm able to save about 20,000 rupees a month. How should I start my investing journey? Very good question. I think a question which matters to a lot of people who are able to save money in the as a starter. I think Prachi, you would
Yeah,
like.
I think for young people who are just starting out and who either do not have liquidity needs, or let's say that keeping aside those short term liquidity needs, um, you know equities is the way
Yeah.
to kind of create long term wealth. For young people, time is on your side, and so um, this is not the age to be worried about whether what will happen in next 3 months. You're investing for next 20-30 years, and that is the goal that you should
Yeah.
keep in mind.
But what I've seen is that young people, they don't really care about 20-30 years. They care about the next goal, right? So for somebody like her, the next goal could be higher education, could be a vacation that they're planning with their friends, or could be a vehicle, to move around, mobility, personal mobility. So these are some of the immediate goals, and these goals, they generally save up for these goals, and these goals are, they need to materialize over, let's say, a year and a half's time. So in such a case, right? So
Yeah.
obviously the answer is please do a recurring deposit in the bank. But the way, at least another probably different way of thinking about is that, let's say, if you do an SIP, right, over, and of course 1 year is not the correct time frame for equity returns, but basically what you end up with is that you have a possibility of earning more than a fixed deposit possibility, and this is just a possibility, right? It's not. And if you fall short, you can always put that from your cash savings. If you make extra, that's kind of an extra bonus. So here what I want to emphasize is that if you're lucky, you can end up more, earning more than fixed deposit. So at this age, you can take that risk, right? Let's say it doesn't matter if you buy your personal mobility vehicle 3 months or 6 months than planned later. So these kind of risks can be taken. But when your goals are more definite, right, that your children have to go to college at a certain age, or you have to kind of have a set goal. Let's say you basically have liabilities. There, the timelines might not be as flexible. So where your timelines are flexible, when you're younger, your goal timelines can be moved around a lot. As you get older, the goal timelines are kind of getting more and more tighter. So hence, your risk appetite can be quite different at different ages.
Yeah, absolutely, absolutely.
So I think with that, anything else?
Yeah, I think just we kind of touched upon, long term
Yeah.
wealth creation and, risk management in the sense of keeping it in line with risk appetite. The long term fundamentals of Indian economy are strong, but keeping in line with the investments, particularly in the small cap space, it's also important to keep an eye on the strong fundamentals of the company that you're investing in, right? And it's always important to focus on high quality um, stocks, particularly in the small cap space. And again, in the short term, um, we don't know when there is a lot of volatility, but sticking with companies with strong fundamentals usually pays well in the
Yeah.
long term.
So, overview of the markets, like there are about 2 lakh crore of FII money that has been pulled back, right? So you have to think about the fact that India is not the only country that FIIs are looking at. Let's say US is considered to be US Treasury bonds are considered to be risk free. If you're getting 4.5% without taking any risk, that's sometimes quite attractive because most of these asset allocators, their yearly target is about 4.5% of return, right? Compared to the fact when US Treasury bonds were yielding zero, now they're getting 4.5%. So their need to need for yield has kind of gravitated towards their domestic market where their basically needs are getting met. It's like if you are getting what you want at home, the need to go out reduces, right? So essentially the same thing. So hence FIIs are basically concentrating in mostly US investors are concentrating in their domestic market. Opportunities for high growth, emerging market companies are performing better returns compared to large cap stocks. So essentially, over a certain period of time, small caps over a complete business cycle always outperform large caps. It's never been a case before in history where small caps have underperformed large caps in a complete business cycle. Complete business cycle is 7 to 10 years. So with that in mind, right, there's a structural advantage when you invest in small caps for the long term.
Yeah, and again, the emphasis here on, small caps with strong fundamentals, high quality small caps.
Yeah, and especially if you get high quality companies, they will exhibit lower beta. We were just checking at talking about some of our portfolio betas, which are in micro caps but are still below one in terms of beta on an average. So if the numbers are that we got from Yahoo Finance are correct, then I would say that we are preferably offering lower beta as a quality proxy. So that said, I think investment strategies for 2025. I think about 2 months have passed, so a lot, 10 months to go. In that time frame, I would still say that overall it seems to be a risk-on market where you should just stay invested. One of the metrics, couple of things that we look at, right? For example, the slope of the treasury yield curve, which means what's the difference between the 10-year versus 2-year, oil price volatility, FX volatility, precious metal volatility. Overall, these things are kind of benign. So essentially it's just profit booking technical bids coming out of like fact that in India around Feb March, a lot of the tranched real estate investments that people have done where people don't take loans, they tend to pay off these around these months. So you're pulling money out of market to put in real estate, which is again another growth asset which will flow back to the economy with a certain lag of 3 to 6 months. And at the same time, you have many salaried class employees who pull money out of markets to pay for their tax related expenses, right? Tax saving needs. So there's a natural bid in the market apart from the FIs. Usually it reverses. So if that's the case, definitely we are looking at a nice entry point if you're a long term investor. And that said, again, these are for a long term investor, any time is good time. We have few live
Okay.
questions. Okay. I'm just trying to figure out how to get to them. So I have somebody from Sanket Kumar is saying that I have a lump sum amount to invest. How should I deploy? All at once or in some tranches as markets are volatile? I think, tranches is always a good idea. See, I think um, it is more risky to do it in en block, and it doesn't give you any particular advantage unless you have any particular insight, right? So, um, I would say like tranche it out, right? But you can keep the tranches close, right? So it's basically you can do it over a month's time, but definitely average out the prices because nobody can predict a day's volatility. So those are opportunities. There's another question, the next
Yeah.
one.
Um, Ninja Hattori, should I diversify to US stocks? Plus, US stocks offer 4 to 5% extra return due to dollar appreciation. Okay. So, in general, it is a good idea to diversify internationally if you have the opportunity, right? But you should not consider dollar appreciation just on top of it, because global investors are investing in Indian markets as well as US markets, and this expected appreciation of dollar is usually factored in. But from a diversification perspective, it is a good idea to invest in US stocks. Some people are saying that US top 10 stocks appear to be particularly overvalued, but outside of the top 10, they may be more reasonably valued. But yeah, so international diversification perspective might be a good idea.
Yeah, I think these are some of the live questions that we got. Do leave some more extra questions in the comments. We'll take them up in the next weekly live session. I think do feel free to reach out to us. Any question that you were not able to ask, or if you watch this video later, if you've been a customer, just feel free to ask. We are there for you, and we are also continuously monitoring the portfolios and market for your on your behalf. So, in case you have any questions, do let us know. And it was great catching up again. I think,
Yeah, yeah,
and
great, great.
yeah,
Yeah, yeah, nice talking to you all. And